Mike Wilson, you're not waiting half a year, you're already there. In this note, we think long-dated bonds could offer a decent hedge for equity portfolios, which are now more at risk due to a growth slowdown. Why is that, Mike?
Well, I mean, it's for the reasons you kind of set up this question, which is I totally agree with your, talking about Senator Shelby's, questioning of Chair Powell and his response to that. I think it's quite clear that this chair is going to go the distance, okay? Meaning they're going to fight inflation, and that's going to require, probably breaking the back on growth. So whether that's a recession or not, I really don't care. But I do think that particularly the back end, 20-year and 30-year tenor, now is starting to look relatively attractive if you're running a portfolio of stocks and bonds. And here's why. Our concern now is growth, okay? Our concern is not about the Fed. The Fed is overpriced at this point, just like it was underpriced 6 months ago. Now it's like a race to see who can have the most rate hikes in. It's kind of comical in that regard. But, so we're priced, okay? We're priced for 8 hikes over the next year. If they get that done, congratulations. And I agree with the statement I wrote this week, the same thing. If they get 8 hikes done and back-end rates move out, that means they were successful in engineering the soft landing. I don't think it's going to be that smooth. That doesn't mean recession. It just means that growth expectations are going to come down. And so if you're worried about growth like I am, then the back end of the yield curve is offering you very cheap protection, like it usually does historically, okay? Because remember, in this sell-off of stocks, and by the way, we've been in a bear market for stocks now for 4 months, not a week. And that's been happening as rates have gone up, meaning bonds have not provided the shelter they typically provide, which means now they're actually probably a pretty good buy for that protection against a further growth slowdown. If you're not worried about growth, then you shouldn't be buying treasuries at the back end, okay? You should be buying stocks. But that's not our view. Our view is that we think growth is going to disappoint.